All right, Nigel, we'll sort of get to these stocks in just a bit, but let's get a few things out of the way. Globalists top of mind. Rajat Bhattacharya, a senior investment strategist at Standard Chartered. He's joining us now. Rajat, good to have you with us here. Thank you very much. You know, let's just pick up where the US left off in terms of data, which is the jobs report. The two-year from about 3.65 in the US, the two-year yield in the US has moved up to just under 4%. Is the market starting to price some of these rate hikes back in? And what does it mean for equities globally?
Hi, morning, Prashant. You're right that the job market data was, again, robust, right? Slightly better than expectations in terms of the numbers. Unemployment rate also fell further. So that, I think, adds to the expectations that Fed will keep going a bit more. So we are expecting another 25 basis points of rate hikes, like we mentioned last time. But that is almost it for the Fed. Why? Because underlying those data, we saw that there was this slowdown coming through in, let's say, the temporary help, which is an early warning indicator for the job market. So temporary health services is slowing. We also see the initial jobless claims, which has been a traditionally early warning signal of the job market. Initial jobless claims, continuing jobless claims, they are on an uptrend. They bottomed in around September last year, and they've been on an uptrend. So underlying those data, while the job market still remains robust, and that gives the Fed one more reason to hike in May, that the underlying data points to a pause thereafter.
So what does this mean, Rajat, for a market like India? You know, there is this expectation that we are heading into a big recession as well in the US. If this rate tightening cycle, even if it does take a bit of a pause, both in the US as well as in the Indian markets, do you think given the recessionary situation, given the kind of broad-based layoffs that we're seeing, this market could head into another leg of a downside, or is the worst already priced in?
Yeah, I don't think the worst is priced in yet because the markets, as you know, equity markets and the credit markets are not yet pricing in a recession in the U.S. Those are the only two indicators across our, leading indicators that we watch for U.S. recession. The two indicators that stand out that are not pricing a recession yet are the equity markets and credit markets. So there's further downside in both markets that we see. Now, if the U.S. does go into a recession in the second half of the year, as we expect, I don't think any market across the world will be immune. But relatively speaking, we do see Asia as a standout. Asia is on a different trajectory altogether because of China's recovery after their lockdown. And you see India still solid growth coming through. The one thing that we need to see is valuations, of course, within Asia, as we maintain all along. Valuations still are a bit expensive in India. They're cheaper elsewhere in China, elsewhere. So while Asia will not be immune, I think in equities, we should be better off being in Asia. In bonds, we see Asia dollar bonds as a top pick because, as you can see, anyway, the Fed rates have peaked, and across Asia, we've seen central banks peak in rates. You saw the RBI talk about pausing rates. So that's positive for bonds across the region in Asia.
All right, Rajat, final question before we let you go then. So would you pick bonds over equities at this juncture post the recent pullback? And also we have a big CPI print that's going to be coming out, right, in the next couple of days. How important is that? What are you factoring in?
Yes, bonds over equities for sure. How often do you get to say that in a year? Very rarely, right? So this is the year when bonds are likely to beat equities, and that more so like places like India, where you see, so RBI peaking in rates for sure. In terms of the CPI data, we are seeing headline CPI having peaked and coming down, but core CPI still remains elevated. Above 5% is expectations, right? So, which is the reason why the Fed is going to be reluctant to stop yet. So that's why we expect another 25 basis points of hike. But as I said, underlying data in the U.S. across the board seems to be slowing. And especially after that banking turmoil saw in March, we are likely to see banking lending conditions tighten further, and that's going to filter through into data in the coming quarters. So as a result, you're probably going to see, CPI, core CPI also decline, but not just yet. Core CPI still remains high for the Fed to hike one more time.
Okay, so you're saying that the worst perhaps is not over for the equity market. So this is not a good time to be buying or putting money to work in a market like India, right?
Correct. I mean, that I would actually, it's a rare opportunity to buy bonds. I mean, this is the time to, adjust your portfolio, buy bonds. RBI is telling us that it's almost peaked. It could raise one more time if inflation stays, high. But that's not what we heard last time. It was a surprise, right? So they paused. So it's a good time to buy bonds, and that's the case across Asia. You've seen Korea, Taiwan, Indonesia, Malaysia. All these central banks have been pausing. You've seen other central banks also pause. So it's a great time to buy bonds, not so much equities.
Okay, great time to buy bonds, not so much equities. Got that. Rajat, thanks a lot for stopping by and giving us quick thoughts on CNBC TV 18. Let's slip into a quick break. Lots of stocks in focus, so many business updates that have come through. So we'll get you more on the fine print in just a bit. Stay with us.